Good morning, ladies and gentlemen. I'm delighted to welcome you to the latest edition of the series of webinars hosted by HVS, Bird and Bird, and EP. We first came together almost 6 years ago in June 2020, and since then these webinars have become almost quarterly fixtures. And I have to say, I think I've always found them incredibly reassuring listening to the experts giving us and guiding us through the various challenges with their insights as we've gone through the last 6 years. And it has felt like a long 6 year period of one challenge after another. And we seem to be there yet again. So I'm particularly looking forward to what our experts are going to share with us this morning. At the start of the year, forecasters were telling us that we were due to expect 1.1% economic growth this year, rising to 1.7% in 2027. But how has that picture changed and how is performance changing? We all know it's changing, but to what extent? The long-term view is apparently good still, but do our experts agree with that? Or are we still to expect slow growth? Valuations apparently stalled in 2025. So how does 2026 look and how does it look going forward into 2027? We have a whole range of questions to be posed and considered over the next 1.5 hours. And we have some great experts joining us this morning. We'd be delighted to listen to STR, Aoife from STR, giving us a good benchmark into performance across Europe and the world. And obviously then Sophie Perrett from HVS also giving us their input as well. And then Simon Price will be hosting a panel of experts to give us their insights into the trends of what's taking place. So I do hope you enjoy this morning. There's a lot to be looked at, a lot to be discussed. And it should be a fascinating time. Now, you will have questions as we go, so please feel free to ask the question during the Q&A button at the bottom. Please touch on it, and we will, I promise, try to get back to everyone to answer their questions. But first, let's start with some polling questions to get a feel for how you view the market at this point in time. Izzy, can I ask you to share the polling questions? So question 1, in your view, what is the biggest challenge facing hotel owners and operators today? The macroeconomic, geopolitical issues, the reluctance of guests to travel, operating cost pressures, finding and retaining staff, or something else? Question 2, it is suggested that the war in the Middle East, economic growth in Europe will average only about 1% in 2026 and rise to 1.7 in 2027. Do you agree with this view? 3, how have your business models evolved and adapted in the last year? Invested in more bespoke personalized services, reduced costs, adapted more AI tech integration, improved the overall customer experience, invested further in ESG, or possess more strategic partners? And question 4, which costs are of most concern to you? Supply chain, labor costs, demand uncertainty due to the cautious travelers, or debt servicing? Is it when you got a chance with the results? So 54% naturally macroeconomic, geopolitical issues, and 40% operating costs. I think that is probably about right, isn't it? What we'd expect. And question 2, 32% believe it's going to be less than the 1% forecast. I think that's probably about correct. And too hard to judge for about 30%. I think that's probably very fair as well. Question 3 seems much more split. 34% adopting more AI tech integration, interesting, and 29% focused on reducing costs, and 34% looking at strategic partnerships. Yes, that seems to be a constant discussion nowadays. And question 4, 50% labor costs. It's interesting, and 37% the demand uncertainty, which is certainly concerning many. Thank you very much, Iz. That's great. And thank you for your views. I think it's probably what we'd all expect. So let's lead into our first speaker. Can I have the pleasure to invite Aoife from STR, Director of STR, to come and talk? Good luck, Aoife. I look forward to listening to you.
Good morning and thank you. Let me just get myself set up here, and you should be able to see my screen. Just bear with me 1 second. All right, off we go. Good morning, everyone. Thank you for having me. I'm going to spend the next 15 minutes giving a very high level overview of what is happening in the market. So first up, from a demand perspective, in the month of March, we have seen a slight decline. So rolling 3 months to February, globally, demand was growing at 2.2%, and that declined to 1.4% in the month of March. Probably no surprises considering the conflict started in the month of March or at the end of February. That positive demand, however, has converted to positive occupancy, 1% growth at the end of March year to date. And actually, in the month of March itself, occupancy grew by just 1% in Europe. You can see a decline in the Middle East here, down 11%. Again, that will come as no surprise to anyone on this call. Now, year to date, the Middle East region and the GCC countries in particular are benefiting from strong demand. So rolling 3 months, that demand was very strong. But as we go into the month of March, occupancy has declined by 31% for the region. The most impacted markets are such as Riyadh, Dubai, and Manama, but I will go into more detail as we progress through the presentation. From an ADR perspective, we have seen a strong performance through January and February in the Middle East again, but ADR declined in the month of March by 11%, which resulted in a year-to-date ADR decline or performance of 5%. In Europe, we see a meager growth, so 1% overall in Europe. Now, we have seen positive occupancy trends over the course of the month. And you can see, however, that in the Easter period, we saw some declines in occupancy, and that was comparing to last year, of course. I'm going to go into a little bit more detail on those occupancy declines. But what we have noticed as we go into the month of April, we are starting to see a gap widen again. You can see that Southern Europe is taking off, and Western and Northern Europe are performing at a lower base than Southern Europe and, of course, Eastern Europe. So we are starting to see, we thought that there would be some softening in Southern Europe as we went into 2026. We are starting to see that gap widen again, considering the circumstances. Now, if we look at Europe as a whole, Easter generally is not great for business in Europe. And we can see when we compare to the previous 2 years that 2026 was no different. So in the week leading up to Easter, we saw a decline of 5% in occupancy and ADR was pretty stable. Now, when we compare Easter week itself, we can see an occupancy decline, so 10% occupancy and 9% ADR decline during Easter week. Now, we are comparing to a much later Easter in 2025, whereas 2024 was a similar period. So that really is telling a story about Easter and when it falls and the impact it has on hotel performance. An early Easter certainly does curtail growth. So we can see here again, when we compare to 2024, the Easter performance was pretty strong. But when we compare to 2025, we are seeing some declines. Now, the theoretical hotspots that we would normally see during the Easter period, again, due to that shift in the Easter dates, we did see RevPAR decline across most markets that would generally do very well during the Easter period as they attract a leisure demand from intra-regional travel, European travel, and of course from long haul too. Only 2 markets saw RevPAR growth, namely Rome and Florence. So Italy leading the charge once again through that Easter period. Now, demand, of course, underpins the ADR outcomes that we are seeing. And you can see here from an ADR perspective, once again, Southern Europe is seeing the strongest growth, as is Eastern Europe, as it benefits from growing demand and, of course, increasing airline seats as well, as I will comment on later in the presentation. So we are seeing again gaps in terms of performance through the region. Now, much of this ADR growth is amplified by luxury. So the luxury class, again, seeing significant ADR growth through March 2026, RevPAR attaining almost 8% growth once again. When you compare that to the rest of the classes, you can really see where that growth is and how it impacts regions such as Southern Europe. Case in point, of course, here is the cities and the countries that are seeing the most ADR growth, considering their inventory, number one, but also considering their source markets. And of course, Milan, slightly thwarted by the Milan Olympics, driving a huge ADR growth, 19.3% year to date. But you can see Greece closely following that with a 13% growth in ADR year to date too. So those markets where there is strong leisure demand, strong international demand, and of course now intra-regional demand through through holiday periods, we are still seeing very strong ADR growth. Now moving to the Middle East. When we looked at rolling 3 months to February 2026, the Middle East was actually performing very, very well, despite Ramadan dates shifting too. So there were an additional 11 days of Ramadan to endure as such. But as a high level of international travel came into those markets, there was also family and Ummah travel that really benefited many markets in the region. But of course, March, on the 28th of February, when the conflict started, we immediately saw a spike in terms of occupancy as a number of travelers were stranded. But that lasted 5 to 8 days, depending on the market. And as you can see here, March occupancy has taken a nosedive, as has ADR. And this is the month of March as a whole. You can see that every country out of the GCC countries are performing quite differently, with the UAE most impacted. And when we consider the international demand that is going into that market, there is no surprise that that market is the hardest hit. Oh, apologies. As a whole, the region is less than half full. When we look at Saudi Arabia here, running 57% in March, that is the top performing region, and compare that then to the UAE with 36% in the month of March. So really the hotels, whether it's economy, mid-scale or luxury, are suffering. At the beginning, we saw that luxury was underperforming for the most part, but actually it seems to be hitting most classes now, depending on the source markets. But as I said, Saudi Arabia is attracting a huge amount of domestic demand, which is helping drive occupancy performance. As you can see here, any market that is above 50% is in the Saudi Arabia region, whereas for the rest of the markets, we're looking at sub 50%. Jeddah, for example, drawing a lot of business from Saudi residents and local demand, so doing a great job. And March performance actually was positive from an occupancy perspective, 9% growth, and ADR flat. Now, that domestic demand, of course, may have a positive impact on occupancy growth, but not so positive on ADR growth. And here is a selection of markets for the week ending 11th of April 2026, where you can see most markets, we're looking at a 30% decline in ADR in that week alone. So really seeing the impact of a different type of demand going into those markets. So although occupancies are rising for some, certainly ADR is either flat or declining for most. Now, there is no doubt that we can draw comparisons to the pandemic. If we look at Dubai alone, we can see how the decline, how sharp that decline is for both periods. And certainly it shows that it is sharper in this one. But we do know that demand will always rebound. And here's some comparison to Arab Spring, January 2011. And we can see, yes, it can take up to 2 years for demand and occupancy to fully recover. but it always recovers. More recently, if we compare again some key markets in GCC countries, when the COVID during the COVID period, we can see that occupancy recovered very, very quickly. As soon as any restrictions were lifted, airspace is opened and travelers can travel, the demand comes back very quickly. So this is the positive outlook that we are hoping for in the coming months. Now, it is definitely too early to evaluate any impact on Europe. As you saw, Europe had a very different experience during the Easter period due to the date shift. But we are seeing more positivity than we saw in February, with 62.2% of all submarkets in Europe showing positive RevPAR growth. Now, this is from Tourism Economics that really feel that Europe will be the least impacted by the current conflict and actually could benefit from some opportunity. Sorry. So that Europe could benefit from some diverted traffic. We have seen some of that already as we see some travelers moving their travels from the GCC countries back into Europe. So intra-regional travel was always expected to recover this year, and Tourism Economics is holding that despite the economic conditions that we are enduring and possibly about to endure, considering the cost of fuel, considering the cost of living, etc. So there's no doubt that Europe holds a lot of risk, but there is an expectation that some travel will be diverted to Europe and Europe could benefit from this. In terms of occupancy looking forward, you can see that some markets, particularly those Southern European markets, and again, the Central and Eastern European markets, are seeing forward occupancy looking more positive than same time last year. However, there are lots of markets that are behind in terms of occupancy on the books. We do have to note, however, that there is a lot of late pickup and a lot of travelers are considering booking later, just waiting and seeing what is going to happen. But certainly for now, we see that things are pretty stable in Europe, and we will just have to monitor it over the coming weeks and months. So that's it for me this morning. If you snap this QR code, you will be able to access all of the presentation that I shared today. And of course, please do reach out to me if you have any further questions. Thank you. And I will hand over to Sophie.
Well, firstly, Eve, before you go, just a couple quick questions. Firstly, your observations from all you've said. Is there anything that hits you particularly when you look at the picture?
I would say that I'm a little bit surprised by Turkey. When I see Turkish Riviera growing, I really expected that to see. We saw in the first few days, we certainly saw some decline in terms of pickup. So I'm surprised to see that occupancy on the books is positive there. That would be my one observation. But then speaking to colleagues and people in the industry, a lot of travelers kind of thinking, okay, let's go. Let's go to Turkey. Let's go to Istanbul. Things are okay. So that kind of surprised me. Easter, I think, again, we forget how much that date shift can impact demand. Certainly the closeness to the February half term and Easter does not help business. So let's see what happens in May. I think May half term will be an interesting one for UK travelers going outbound. And other than that, I would say, look, the GCC and the Middle East as a whole, keeping very close to all of the hotels that we work with. We have seen a number of closures in the last few weeks of some luxury hotels that are going to go into refurbishment. They're using the opportunity, right, to upgrade. But certainly it's not an easy time, but we're closely monitoring the situation and we hope that the next few weeks we'll start to see some movement. But the traveler is so resilient. And as soon as the airspace is open, we know that demand will come back.
No, that's brilliant, Eva. Thank you so much for your contribution
Thank
today.
you.
That's excellent. And now may I ask Sophie to come and join us? Thank you, Sophie.
Hello.
Sophie?
Hi.
Hello.
Hi, Chris. Hold on. Let me get the camera going. Okay. can share my screen. There we go. Are we all set? Good. Let me just sort out the video because somehow I didn't manage to get it going. Okay. Start my video. Here we are. Hi, everyone. Today I'm going to be talking about hotel investment into Europe. We're going to be looking at transaction value trends for the recent past, the impact of previous crises on the hotel sector, what lessons we have learned, and we're going to have a peek at the outlook for the remainder of 2026. In terms of hotel investment, 2025, as you can see, was a very good year. We were some 30% higher in terms of invested volume as compared to 2024, which was already some 30% higher than 2023. So with all of that, 2025 is actually the best year we've had so far since 2019, and is overall the third best year in terms of volumes invested into Europe ever. And this is mainly driven by single asset transactions. So where was the activity? We can see the UK remaining very, very liquid, top of the list, followed by France, Spain, and Germany in that order. And between these four countries, we're looking at broadly 2/3 of the total investment into Europe in 2025. And the most liquid cities were London with 2.3 billion and Paris at 1.9 billion remain top of the list, some 18% of the total investment volume into Europe in those two cities in 2025, so very impressive. And in terms of where we find ourselves end of Q1 2026, well, investment volumes are down, but about 14% on the same time of 2025. But I don't know that we can really read much into that because the hotel transaction, very lumpy business. So things can shift very quickly. And if you look at the Q1 2025, actually, that was down by about 15% on the same period of 2024. And yet we ended the year 30% higher. So, of course, the context in 26 is particular. So it's a space to be watched, I think. And in terms of the most noteworthy transactions, I've listed a few, no portfolios that were relatively small, but in terms of urban transactions, we have that very impressive transaction of the Pullman in Paris, which went for about 1 million a key. And then we have a couple nice resort transactions as well, with the Penhalonga in Sintra, Portugal, almost 700,000 per key, and the Jumeirah in Mallorca, more than 500,000 a key. Yield data, we're always craving. We're looking at 10 years of data here. This source does include quite a little bit of operating leases. Obviously, we need to look at it with caution in relation to the different profile of operating leases. But overall, the trend is fairly illustrative, we feel. And the last 3 years, actually, what we see is those yields hovering between 6 and 6.5%. On average, they were trending up during the course of 2025, which is probably a good reflection of the uncertainty building in the trade wars and what have you. I don't really know what to make of that Q1 2026 with a little bit of a deep, and I think we don't want to read too much into that. This is certainly not reflecting the start of the war at the end of February. So if we look at values, what we're tracking here is a sample of 31 markets across Europe in our hotel valuation index. Towards the end of 2025, we were seeing very, very marginal value gains, 0.2%, so practically flat, really. There's a very divergent picture, though, between these different 31 markets that we're tracking. Only 2 of the markets actually gained more than 5% in terms of values. We had a good 42% of the sample actually experiencing some sort of declines. And then we have more than half of the sample, which were hovering somewhere between 0% growth and very minimal growth overall. So just to give you a little bit more of a flavor on a per region as to how things were evolving, Southern Europe continued to do really well. Leisure continues to drive momentum and drive those revenues. Investment appetite continues to be very strong. We saw how Spain was actually the third most liquid market in 2025. So that investment into these markets means CapEx for the hotels, repositionings, rebranding, and a whole lot of positives here, which continue to drive real value for Southern Europe. Eastern Europe is also on a positive path. I mean, this market is more still about recovery, this regional more than market. But here we were in a position of very strong inflation post-pandemic, low ADR growth. So this is reverting, or certainly kind of building up momentum, and the news a couple of weeks ago from the elections in Hungary certainly continued to build towards that positive momentum. In Western Europe, things are more mixed, and we have a collection of different things. So if you look at, for example, say Paris, 2025 is a kind of a return to normal after a fairly weird 2024 due to the Olympics. So that was a happy place, good strong performances. Amsterdam, not so happy. In 25, there was still, the pain of the city tax imposed in 2024 that was being felt. And from January this year, actually, VAT has increased from around 9% to 21%. So Germany, mixed bag. So 24 was actually a pretty good year over there with lots of one-offs, like such as hosting the UEFA Cup and the Eras Tour from Taylor Swift, really driving demand. So 25 is a bit more of a return to normal for the German markets. And in Northern Europe, finally, it's worth highlighting that Copenhagen is having a very, very good performance. The demand for Copenhagen has been very strong for a number of years now, but there was also a fairly substantial amount of new supply coming in and sort of offsetting the impact of that strong demand that is now becoming very visible. So the value changes that I was mentioning illustrated on a map here, and we can see Eastern Europe, Southern Europe there with positive value changes. And those two markets that I mentioned at plus 5% are Athens and Copenhagen, top of our list. In terms of relative values per keys, some of what we're seeing here is kind of same old, and that Paris and London lead and are quite a bit ahead of any other markets. That huge Paris bubble there is, I think, a good illustration of that initial transaction that I showed you for the Pullman in Paris, Tour Eiffel at 1 million a key for a hotel, 435 keys. That is saying something. Mediterranean markets doing pretty well in relative terms, and we can see how Athens is also kind of catching up over the last few years. It's increased in value quite substantially and is now in a comparable kind of basis with, say, Brussels or a couple of the German markets. And the key drivers of those changes really on the positive side in 2025, obviously we had that continued desire to travel, wellness drives and experiencing and so forth. Cycles of refurbishment as well, I was mentioning earlier, and for some markets, a decrease in the incoming new supply. All of those have been positives in 25. We see F&B contribution to total revenues or any efficiencies, operational efficiencies in the P&L sort of plateauing in terms of the positives they bring to the P&L. Energy had certainly stabilized in 2025 now. This was then, so of course, a space to watch during the course of 2026. And in terms of diminishing profitability, we obviously have wage growth still catching up with those strong years, post-pandemic inflationary growth and what have you, and then all sorts of government taxes, having a dent on profits. So we thought we'd look at a good almost couple decades of value changes. Again, this are driven by our hotel valuation index that we track every year. We looked at the last two shocks that have actually impacted the hotel space. We remember, obviously, the pandemic very clearly because it's relatively recent, but we also wanted to take a look at the GFC and understand how we came out of that previous crisis. The GFC being a financial crisis in nature, it did generate an economic recession of a significant magnitude, which actually resulted in corporate travel all but evaporating. And leisure travel also suffered massively. There was lots of unemployment and what have you. So those lower occupancies did put pressure on ADR. There was price wars that actually were really detrimental to cash flows. Banks that were not very knowledgeable in the space pulled out, investment markets froze. So it took a while to come out of this pretty difficult space. Western European markets only started to come back in the sort of 2013 or so. But Southern, Eastern Europe, those markets had more structural problems, ongoing recessions, unemployment, housing bubbles. It took much longer for those markets to come back. And so that situation of cash flows being really under pressure, but also coupled with higher leverage, which was typical pre-GFC, that resulted in quite a bit of distress and the creation of those bad banks back then. So the context post-pandemic, very, very different. All those people came out of the lockdown, plenty of money in their pockets and just wanting to travel, which was good for top lines, especially in the leisure markets. But there was also substantial support from governments. The lenders remained very active and very supportive as well. But I think the things to highlight here is that we did have to cope with inflation, which was kind of a bit of a novelty after so many years of no inflation. And so there was great focus on actually building those efficiencies into the cash flows and building cash flow resilience. That was very important post-pandemic. And also we were enjoying actually much more conservative levels of leverage into the hotel space. So that what it did is that actually those strong cash flows and lower lending into hotels resulted in a lot less distress. So we wanted to compare a little bit the time that it took for values to actually recover after these two crises. What we did is look at values and index them to the year before the crisis. So for the GFC, that would have been 2007. For the pandemic, that would have been 2019. And as you can see, it took about 5 years post-pandemic for values to actually return to 2019 levels. It took 8 years post-GFC for the same results. And that sort of length of time also bears quite visibly, actually, in the transaction space when we look back all those years. And we can see how those poor cash flows, lenders being absent, and investors just really not being interested in the sector post GFC actually are reflected in that poor transactional volumes there. Very different story post-pandemic, where even the level of transactions during the pandemic remained stronger. Lenders were still there, and the hotel space actually positioned itself very much as an investable asset type. So a pretty different story altogether. And so how are these different situations sort of helping us on the ongoing geopolitical situation, and to what extent are we better prepared for the number of challenges we have ahead of us? And nothing here that you haven't heard of. Obviously, the Strait of Hormuz remaining closed is bad news for inflation, which is bad news for interest rates and the perception of any potential buyers when looking at possible transactions and their exit expectations. We are worried about the impact of the fuel crisis on the price of flights and whether that can impact demand. And just altogether, are we going to lose out on demand from further east as well? And in the context of all of that, we also have the cost of development, which had finally sort of stabilized after many years of substantial growth. Now supply chain disruptions and energy increases are bad news for the cost of developments. And so how is the hotel sector positioned to weather all this fallout? As Aoife mentioned, location will remain a positive for Europe. There's lots of talk about European staycation, and we hear the likes of TUI, for example, saying 75% of their bookings are actually for Europe at the moment. We might benefit from displaced demand from the US and other source markets, maybe not traveling to the Middle East or further east and staying in Europe. So Europe as a safe haven for travelers, but also potentially for investors, are positives. However, I think we need to be pretty careful, because that European staycation in terms of occupancy and ADR will not benefit all markets alike. We need to be very reactive and agile in terms of where that demand goes. What I'm hearing is the further away you are from the conflict, the better. So maybe Portugal is better placed than Greece, say. So in terms of that cash flow resilience, again, I think we are well trained post-pandemic to deal with inflation. So that is a positive. We're also kind of well attuned with the increases of the cost of debt. So those are definitely positives under our belt. In terms of what we see, what is the outlook for 2026? Well, Europe remains a very, very well-positioned continent in terms of attracting travelers. As we could see for the Q1 performances that Eva was sharing with us, the RevPAR story remains a positive one. We do, however, need to be very careful. I think, again, agility and reactiveness will be key to understand where that demand is flowing to, and we will have continued wage increases and more inflation and other challenges coming ahead of us. Global trade disruptions, if they continue, are going to just amplify the challenges. Overall, however, silver linings are that European staycation displaced demand coming into Europe as positives that some markets more than others will be able to capitalize on. The increased cost of debt, however, is going to put pressure on values, and it's very likely also the transaction volumes might remain low until uncertainty eases, because investors do not like uncertainty, and we have plenty of it. Thank you very much.
Thank you, Sophie. That's excellent. Can I ask again the same question? What strikes you when you look at all this data as we look forward? Is there anything particularly?
I guess it's the speed, Chris, at what things are evolving, and just seeing how people are already booking that. They still want to travel, so they are booking holidays. I mean, the cost of flights is likely to increase massively. We have all these discussions about fuel crisis and what have you, but people are booking the travel. They are being very reactive, however, to the geopolitics, and they're thinking, well, I was planning to go to this and that location, but now the hubs in the Middle East might be challenging to go through. I'll just stay in Europe. There is that perception of this being a safer option, and I guess in the end of the day, we might also see that drive-to destinations are going to be popular if and when traveling by plane remains even more challenging. But that this is just the reactiveness and still the willingness of people to overcome all the challenges and keep on.
It's interesting, isn't it? Yeah, it's really fascinating, I have to say. Actually, I thought the stats overall were more positive than I expected in some ways. So it is an interesting picture. Sophie, thank you so much for your time. That's a fascinating presentation, so thank you. And Simon, delighted to welcome you. I'll let you introduce your panel. Good luck.
Thanks very much. Yes, I'm Simon Price from Bird & Bird's Hospitality and Hotels team. And I'm going to just start by introducing my panelists today, which is Felicity Black-Roberts of Hyatt Hotels. We have Kate Nichols from UK Hospitality. Jack Rice from Barclays Bank. Carrie Wicks of Core Ventures. And Tina Yu from KSL Capital Partners. So welcome to all my panelists, and thank you for joining us this morning. For those listening, please do keep the questions coming in. I will try to monitor them, and if there's time, pick out a few to put to the panel as well. So I want to start by looking at investor and funder attitude to hotels. We set up this seminar early in 2026, before there was trouble in the Middle East, coming off the back of the very positive fourth quarter of 2025, as Sophie highlighted in her presentation. So, Tina, if I can start with you, coming into 2026, what was the sentiment for hotel investors into the UK and European markets?
Well, I think I suppose our general view was that this was going to be a good transaction volume year. I think people had the same view going into 2025. Unfortunately, we had the tariff day that hit around the same time probably that this Middle Eastern crisis hit. And so I think originally coming into the year, the view was there was going to be a wave of kind of financing maturities that were coming up, some CapEx driven dynamics, as well as just investor hold periods of having the transactions that were done 5, 6, 7 years ago and perhaps a leveling off of a post-COVID bump in, double-digit growth that would drive some interesting transaction volume at prices that, finally close the bid-ask gap. Now I think there's probably a little bit of a pause in the market when people are trying to assess, frankly, what all this volatility really means.
Thanks. I suppose I'll come back to you a little bit more just to talk about the pause and how long that's going to last for. But just, Jack, can I just get your perspective as well? Lenders, is this is a hotel sector something that lenders are looking positively at coming into 2026?
Yeah, absolutely. I mean, the 2025 was sort of single asset transaction year, and actually, as lenders, not just at Barclays, we were able to support many hotel owners and operators into doing that market. I mean, I think investors in the UK are looking at fundamentally two things at the moment, and that's where can they see those value add opportunities? So, in some cases, turnaround opportunities, and then also a clear fight for quality. I think it's still persists into 2026 and it is a follow-on from 2025. So luxury and ultra luxury assets in prime getaway cities are the ones that the investors are focusing on. I think the ultimate question is what could they add onto top of those, and that will sort of lend us light to some creative transactions in the market. And as Tina said, that bid-ask gap is closing and will continue to close. That's the view from our perspective. I think in part also to some of the obvious headwinds in the industry are closing that gap. So those discussions in those bidding situations are actually quite straightforward, whereas they maybe haven't been before.
Okay, fantastic. And so, I mean, we can't avoid, obviously, the last few weeks of conflict in the Middle East. So, I mean, Tina, does that put, is this just a blip that once the ceasefire looks like holding or there's some kind of settlement, things will just bounce back and investors will be happy again? Or do you see a return to a sort of potential stagnation in the market as people just reassess particularly in things like uncertainty on interest rates? How much effect is this going to have on a longer term basis?
Look, I think I'll speak from our perspective, right? KSL, we're long-term believers in the hospitality and leisure trends. It's the only sector we invest into. We're not generalist real estate funds that rotate in and out of the sector. And so our fundamental view is that hospitality demand and leisure demand has incredible tailwinds behind it and great long-term growth. So we're always going to be investors in that market across the capital structure, whether that's debt or equity. I cannot say that it hasn't changed our view of the world, though, right? And so I think anyone who is looking at a deal today has to be looking closer at certain cost item, paying pretty close attention to what the pacing looks like this summer, and thinking through sort of what would happen in a downside scenario, and trying to at least tie up financing without taking that type of risk in transactions. So we're certainly not risk off the sector, but you have to reflect what's going on in the world today. And I'll tell you, I think this is more my personal view than our house view. My worry is less the demand pattern in Europe. I do think that intra-Europe travel, as Aoife and Sophie talked about, is going to be a net benefactor in Europe. My worry is really actually the supply of airlines and flights. You've already seen quite a few airlines come out and announce that they are going to cut certain flights if this gets prolonged. And Europe is probably the most exposed to energy being such an importer of energy and oil, right? So that's what probably worries me more than people not wanting to travel. And that's quite a resilient part of the demand in Europe.
Thanks very much. And Jack, coming back to you, just have lender attitudes changed as a result? Have borrower attitudes changed? How are you managing to cope with pricing of deals at the moment?
Yeah, I mean, from a lending perspective, our appetite has not changed at Barclays. We continue to be sort of supporters of the hotel sector, and that can hopefully be seen by some of the large transactions we've done in 2025 and already in 2026. Some of those being sort of public knowledge and some not. We have a long history of supporting across different, should we say, macroeconomic cycles. So no, our lending has not changed, and we continue to support those businesses that are looking to either complete those capex refurb projects or looking to acquire new assets. I mean, more widely from an investment perspective, I mean, the UK can now be seen as a safe haven during the conflict, and so investors are increasingly looking at the UK, particularly London, as somewhere that they want to put their and invest their capital. And this is only likely to amplify some of the points that Sophie and Tina have said around sort of creative deal making and that focus on finding the right asset moving forward.
Fantastic. Kate or Carrie, I don't know if either of you want to just come in terms of the perspective you have on the kind of investment and lending atmosphere at the moment in the UK and Europe.
I'm happy to make some additional points. I think I would echo everything that Tina and Jack have said about the appetite for investment back into the hotel market across Europe. You have seen a shift in attitudes as well. I think, you know, what's been happening in manufacturing, in AI, in other areas that people might have gone for, some of those higher risk, higher reward areas that looked attractive. You've seen a move back to capital that was looking at a safe haven for long hold and long yields, and certainly a move back into the high value hospitality sector. I think I would differentiate between the UK and Europe. I think in the UK, there is still that nervousness around the cost, highest employment costs and employment taxes, highest energy costs, highest property taxes, and the government unpredictability around what it's doing around business rates, national insurance, holiday taxes, not helping. So what we're hearing from global investors is, yes, they like the idea of coming back into those assets. They can see appetites. As Tina said, there's some really incredible tailwinds, very heavy headwinds, but heavier in the UK. So if they're looking at where they're putting their money, it's less into the UK market at the moment. There's a bit of a pause and a hold off. So that's the only thing that I would say is an additional point, that we have some greater headwinds in the UK over and above what's happening with the war in the Middle East. When you then look at it now, looking at that sort of narrower perspective, again, out of European markets, the UK is more exposed to those routes and those travellers that transit through the GCC, Australia, New Zealand, India, China, Japan, Southeast Asia, and perhaps less able to benefit from the interregional tourism that you might get. So I think, you will see interregional tourism across Europe, whereas the UK has that additional barrier of further to travel, additional checks and balances. So that will have a short-term impact, but I don't think that's as significant an impact on an investment decision into the UK as our broader tax environment is.
Okay, thanks. Carrie, did you want to add anything to that?
Yes, thank you. Interestingly, I mean, we're finding we're sort of out for funding at the moment. So we're finding that the end of 25, it was very much a single asset sort of interest, and now more of a platform. So where we are, and the platform actually also, it's not just UK, it's actually also kind of Europe based too. So we're seeing that from our perspective. We're also seeing that we are finding that the de-risk, it's planning and permitting seem to be quite a thing at the moment, where we are from an investment perspective, and it's very much sort of the de-risk of that. They would rather have an asset that actually needs some sort of a change, renovation, improvements. We talked about turning around, things, development of a going concern, as opposed to something that's been kind of closed and needs reappointing, replanning, and so on and so forth. So we're kind of finding that too. So it's a de-risk in the funding is more of a interest to investors out there.
Thanks very much. Felicity, I want to come on to you if I can. Hyatt have obviously substantial numbers of hotels across UK, Europe, and the Middle East. I want to come on to the more brighter aspects of the sector in a moment. But I mean, how is the Middle East situation affecting Hyatt at the moment?
Yeah, I mean, I wish I could say something different to what you've already heard. Obviously, from an operator's perspective, the first reaction in this situation is caring for the guests that are stuck with you, and then caring for the employees and and making sure that everybody is where they need to be and are comfortable and feel safe. I think as a wider point as to what we're seeing in the Middle East, is again that ingenuity that we see through operations teams, for instance. Grand Hyatt Dubai has been creating staycations. So sort of that sort of pandemic spirit of how do I get people through the door and leverage the facilities I've got, albeit I might be leveraging them at a lower price point, or inviting people into the hotel who wouldn't normally be a guest here because they live in Dubai, but inviting them for the weekend as a staycation. We've got a great water park there. So there's, we're able to create a program for the whole family. So I think that enduring spirit that we all saw during the pandemic has come through to some extent in the teams that we've got on the ground in the Middle East to make the best of a bad situation. And we've seen kind of spikes and falls and dips depending on different things. At one stage, Riyadh Airport had much better airlift than Dubai Airport, so suddenly occupancy in Riyadh was almost full. Um, that then petered out. We saw different. So it's kind of shifting as the geopolitical situation shifts. But we are seeing a general calming of the situation now, and certainly we've started to see a little bit more movement around the region. But it's not pretty for a
And are you
picture in terms of
seeing
trading.
are you seeing a positive effect then, a knock-on positive effect into the performance of your UK and European hotels?
Yeah, I mean the whole staycation piece is kind of holding true, and in London at one of our hotels this week, and you can see the shift sitting at breakfast. You can see the shift in the profile of guests that we've got, and certainly there's a lot more European guests here than we would have normally had. It would normally much be more angled towards Middle Eastern guests and some Americans, whereas now actually you can really sense there's a lot more Europeans around. And certainly for our leisure hotels, because we have a large component of resort properties in Spain and the islands, the pace of bookings for this summer is way ahead of where we would have seen it last summer. And obviously, the concern now is then that airlift following through and being actually able to put the people to the place where they want to be. And I think that is something which is very much on the consumer's minds right now, is what is that airlift piece going to look like for the summer? Because for sure they want to go on vacation. That sentiment hasn't changed. We saw that coming out of the pandemic. People are willing to spend their money on holidays, time with family, and really going for a much more elevated experience than perhaps they did pre-pandemic. So we haven't seen that trend change. People seem to be willing to prioritize that expenditure on travel, which is great and echoes back into what Tina's saying about the overall fundamentals of the sector. But, I would echo, and I think it was Tina who said it, concerns over airlift and how people may be able to get to destinations and disruptions generally on travel.
Yeah, thanks. Tina, just coming to you. I mean, there's a question in the Q&A that's sort of similar to the one I was going to ask you anyway. Looking at bright spots, geographies, and segments in the market, where will you be looking closest over the next few months in terms of investment opportunities?
Sure. Look, ultimately, none of us in this room can control airlift, right? Or stop the war in the Middle East. And so I think it is an overall concern, but certainly it's hard to predict that in terms of where we detect investment volumes. Fundamentally, we still very much believe in Southern Europe. We think those Mediterranean markets in terms of leisure demand probably will have a good summer, all else being equal, truthfully, in terms of the airlines being there. We are big believers in wellness, more experiential travel and luxury travel, as you guys know, in terms of where we invest into. So I think concepts that have that unique demand driver, something to make the consumer want to go, they're prioritizing those things. And so we're continuing to looking at those concepts and those markets. I do want to say something interesting. There's a few public travel companies that's come out with some earnings kind of data, which I find interesting. People are pulling forward their bookings. for the summer, or at least for the May kind of May breaks, bank holidays in the UK. So I think Airbnb had noted that UK Airbnb searches were up 15%. A few of the holiday makers were saying people were pre-booking those travel packages to Southern Europe for May. And so I think there's a nervousness around the consumer dynamic that actually is prices are only going to go up from an airline perspective. So people are pulling those bookings forward, which hasn't been for a long time where we saw a long kind of non last minute booking. So now I think I'm not sure. I think that's a good sign that demand is still very much there. It's just a question of whether these airlines are going to be forced to cancel some of these flights if this prolongs.
I absolutely echo that, Tina, and we're seeing that in our pace reports right now. It's definitely people are starting to think earlier than they had been doing previously, for sure.
Yeah, and the themes that you said, Tina, in terms of luxury, leisure, and wellness, I mean, those came out of Aoife and Sophie's presentation as well as being some of the high spots. So I suppose it would be helpful just to get perspectives, maybe Carrie or Kate. I mean, across Europe, cost of living issues means that people's available spending is squeezed. So what's the evidence as to how much, what's the attitude of consumers, I suppose, to still spending money on leisure and travel and holidays?
If I go first on that, we do a customer sentiment tracker with CGA Nielsen, have done every month since the pandemic. Actually, Q1 in the UK was where customers were saying that they were still feeling peak cost of living pressures. So 76% of them saying that it was more severe than it had ever been. And there is a real lack of confidence and a nervousness. I don't think it's necessarily always mapped out against reality, but there is certainly in the UK consumer mind a really intense cost of living pressure that they are facing or are facing into. And for the first time across all 3 months of Q1 before we had the war in the Middle East, we had consumers saying downgrading intention to travel, particularly travel abroad. They were looking at more domestic, they were looking at day trips, they were still prioritizing eating and drinking out and socializing with family and friends. But as that got more expensive, they were doing it less frequently and they were prioritizing that ahead of outbound travel. So travel slipped down. It's always been roughly, when we ask the question, if you've got any disposable income, what would you do? It's always been in the top 5. It slipped out of the top 5 for the first time since COVID. So undoubtedly, those pressures are very real. We are seeing hesitancy to book, very softening of demand and a late booking for people coming through. So I think it's difficult to be able to get any real insight because of the fluctuations around the date of Easter that we've had, but we are seeing sort of softening of demand on the books and a reversion back to very late booking. I think as well, people looking in the UK waiting to see whether they will travel abroad, whether they will fly, whether there are cost implications before they make their decision as to where to go and when to book.
And Jack, can I just check with you actually very quickly? I mean, I know that Barclays have their own consumer spending surveys. Does what you heard Kate say accord with what you see?
Yeah, it absolutely does. I mean, if you look at the travel, we recently reported our March data, and actually travel spend from a transaction volume perspective was down 5.5% compared to the prior year, and that's the first negative we've seen since the pandemic. So I definitely think that yeah, what Kate's saying is absolutely correct. I mean, what I would say is that I heard a quote recently. It was in good times people want to travel, and in bad times people need to travel. So it's also an interesting dynamic between actually spend volume going down, but then what Tina said about people bringing their holidays forward, because actually that seems to then amplify that message about people needing to travel, and actually they're trying to find ways around the conflict to try and have that travel and try and build that into their discretionary spend. But I mean, in terms of consumer data more widely outside of travel, but just across the sector, what we're seeing is consumers are going out less, but when they are, they're spending more. And that leaves a real focus onto operators to provide that good quality experience. So that's when people are checking into hotels, are they doing it in a quick manner? And if it's a self-service kiosk, is it working effectively? So all of these little pinpoints are building into that customer experience, because critically at this stage you want that repeat customer, people coming back, and it's just so important to consider that. And I think just quickly on what Felicity said earlier about the leveraging facilities, I think that's a really important point. Another phrase I've heard recently is experience density. So it's where people are spending more, it's capturing more of that wallet spend when they are increasing that spend per head.
And thanks very much, Carrie. Looking at this staycation market and the sort of trend towards people wanting to do more sort of in the leisure and wellness, how are owners and operators that you're advising adapting to this?
Well, I think, going on from what Tina said about the sort of experimental aspect of guest experience now, I think it's gone to the days where you would sort of just enjoy, I think, personally, the hotel for what it's just got to offer in terms of food and beverage and accommodation. We now need to add a lot more to that experience for the guest perspective. And wellness is a huge part of that now. There's no doubt about it. It's becoming something that it's a holistic approach. It's mind, body, soul. It's the complete sort of aspect of looking after yourself, but at the same time having your mind stimulated. There's a big sort of, I think, fight between the conscious and the subconscious at the moment. I feel that a lot of sort of the generations are feeling that they want to go and be able to relax, but actually they can't. They can't turn their minds off, but they want extra experience and extra stimulation. So it's experiences that you're sort of pushing the boundaries, taking them out of their comfort zone, giving them something something completely different. But also, I think it's making sure that you're sort of you're learning, you're continually learning, and we're kind of going into the aspect of trying to adapt and make sure that from the minute you arrive, the minute you leave, that you're being entertained, you're being looked after, you're being cared for, but at the same time you're being stimulated mentally and physically.
Fantastic. And Tina, I ate at one of the pig restaurants recently midweek. It didn't look to be doing too badly at all in terms of numbers of people there. But is that, you obviously have a UK staycation sort of presence? Do you agree with Carrie that you're sort of under pressure to do more in the kind of experience and wellness aspects of your operations?
Yeah, look, I think Pig's a great example. It's a highly unique concept and brand that people like and identify with. I think we pride ourselves in providing warm, relaxed service and kind of a great delivery of food that hopefully will keep the customers coming back. And it does drive a pretty impressive midweek business because of that. I don't know whether it's really pressure as much as to say, I think the customer today is pretty smart, right? They've got access to everything via AI, social media, and stuff to know what good looks like, to know what they want, and you have to innovate a bit we have to innovate a bit as an industry to say it's not good enough to just give them a good bed and good shower anymore, especially when they're on a leisure travel. Corporate travel is a bit different. And they expect something different. They want to know why they should come to your hotel. And if not, they have plenty of ways via the different OTAs and social media and AI channels to find someone else who does give them what they want.
I want to come on back to point that Kate, you mentioned earlier. You touched on a list of pressures that the UK hospitality industry and that we're under, and I'm sure these are replicated across Europe as well. Can you just highlight which of those pressures in terms of costs you think are the most damaging to the business and I suppose the most long lasting in terms of cost pressures that operators are facing?
Yes, I actually don't think they're led as much over Europe. I think we have created a bit of a problem situation, a problem child in the UK market, I think. First off, across the rest of Europe during COVID, hospitality businesses were given more grants rather than loans. and were often given rent holidays as well. There was a sort of rent furlough that was given. This is broader than hotels, it's hospitality on the high street in particular, but it is a delicate ecosystem and infrastructure. So you have a bigger debt problem in the UK that businesses in the hospitality sector are grappling with and have an indigestion point on. We were always the one of the least price competitive markets for tourists to visit. But one of the benefits we had was a flexible labour market and low taxes in our labour market. So we kind of had a bit of a quasi-American European model. We have now shifted much more firmly towards a European model of labour regulation. And we now have the highest employment taxes in that marketplace. And again, we are property intensive, we are labour intensive businesses. And I think it's the big change that you've seen is that increase in employment taxes over the last 2 years. So we have the highest employment taxes, the second highest national living wage in the world. And then underneath that, it's property, so it's business rates. And we've seen very big changes in business rates for hotels over the last year. So those are the bigger changes that I think distinguish the UK market and mean that investors are just a little bit more cautious about investing in it. Those are hospitality specific, they are UK specific. And over and above that, there is the general uncertainty and unpredictability of what this government is doing in terms of regulations. And long-term investments don't like uncertainty.
Fantastic. And Felicity, obviously, as a major representative of a major operator, how are Hyatt finding the cost pressures, and is there any other particular way that they're looking to deal with them?
I mean, I think the whole cost pressure issue, as Kate rightly says, is different for different jurisdictions, and we see different pressures in different places. You can take Amsterdam, for example, with the new VAT, which really hit the market and was trying to work out how to get that stabilization back in the Amsterdam market. I think, we're both a franchisee and a manager and also owner of some of our own hotels. Honestly, in the franchise scenarios, we're looking to support our franchisees to drive sales as hard as we can. They're generally very good at managing their cost base, and it's really providing them with the support through how we think about brand standards and delivery of brand standards to make the most of small teams on the ground, particularly for properties which are falling into upscale and below. I think in the properties that we're managing, again, the sophistication of the investors in the sector now is such that there's very good and strong dialogue between our owners and ourselves, and that dialogue is around, and especially because we're generally managing properties which are upper upscale and luxury as opposed to the lower categories within our brand portfolio, is how do we deliver the customer service that is expected at that level in a cost efficient way. And I think the role of very active investors, organizations like KSL, and how they interact with that brand managers like ourselves is critical in kind of creating an atmosphere in which we're all working together to really drive efficiencies in the cost base of each hotel, maintaining ultimately some service levels which are expected from the brands. And let's not forget, consumers are demanding, and we've just heard a lot of people talking about what consumers are expecting now, and the transparency of the market. So it's a difficult balancing act, to be honest.
Yeah. I'm going to ask two questions. One's from the Q&A, and one is something that came out of the Sophie's presentation. So the Q&A, and this is open to anyone who wants to answer it. In Europe, and especially Northern Europe, have you observed any shift in investor preferences regarding hotel investment structures? Specifically, are investors currently favouring franchise agreements, etc., or alternative operating models in light of market uncertainty? I don't know whether is that one for Tina or Felicity?
Yeah, I'm happy to jump in terms of what we're seeing in Northern Europe. I mean, obviously the lease is a thing and has been a significant driver of how the markets in Northern Europe have evolved over time. There's been quite a lot of problems with covenant strength and tenant covenant strength, and we've seen some notable insolvencies. But that doesn't seem to be affecting people's need to and desire to lease. Obviously, for that then drives franchising because we have the third party operators taking leases and brands like ourselves providing franchises. I think what we're seeing more and more when we're looking at new opportunities is finding an alignment between the landlord, the tenant, and the brand in terms of the landlord really looking to lay off covenant strength risk and how that is managed between the triangle of the three parties. We're seeing, honestly, in Northern Europe, less and less hotel management opportunities.
Yeah. Okay. The other question I wanted to ask, again, it came out of Sophie's presentation as one of the more recent trends was the use of AI, and I wanted to just check, does anyone have a perspective on the panel as to how AI is helping with some of the cost pressures that we're seeing in the market? Go on, Jack.
Yeah, happy to jump in there. So there's a couple of things about AI. So in terms of maybe your more upper luxury scale hotels, I mean, there's things around hyper personalization or ultra personalization. So things like facial recognition when someone walks into the reception of a hotel, and that information can be screened to the receptionist or the porter, and so they know what that person's preferences are, thus creating that better experience for the customer. And then in terms of more around efficiencies, I mean, we've obviously had this sort of stock analysis technology for a number of years now through MS Dynamics or other platforms, but actually now we've got a more sophisticated version of that, so that can help with things like staff rota efficiencies and creating that sort of hours per revenue per hour per available room and things like that. So I'd say there's two things there that could support the industry. It's still being looked at heavily. In most conversations I have with clients now, we're talking about that, but there's no necessarily a silver bullet as yet. But these sorts of staff rotas, kitchen porter, things like that are coming through quite significantly.
Thanks. And Karen, can I just ask you in terms of, Jack mentioned to do with employees. I mean, in the businesses that you're advising, how big a problem is recruitment, retention of employees, and getting that balance right between customer service and cost efficiency?
Yeah, I mean it's tough at the moment. I think we all know that. We've all touched on that, and it is difficult. And I think at the end of the day, what we have to do is to spend as one size doesn't fit all anymore. And I think there was an element of that where we was sort of it would be the staff benefits would be global staff benefits. There'd be I think now we have to it's almost like you have to have a sort of the dream manager type of role within an organization where you are able to kind of get under the skin of as many people as you can, and hopefully the whole of your team, and to understand what their ambitions are, what drives them, what their career path looks like, what they want to be, what they want to grow into, and how they want to develop. And I think also what their aspirations for their own home environment is as well. You know, it's very different to, I think and we sort of, from that perspective, we are talking about making sure that each individual is being nurtured and being sort of given the opportunity to be able to have their ultimate career path or their ambition or their even their home environment enhanced by what we can offer.
Yeah. We've got about 12 minutes left, so I just want to come on to keep the questions coming in, please. But I just want to touch on development activity and the development pipeline. Tina, can I ask with you? Just doesn't have to necessarily be a house view, but what do you think the biggest challenges are at the moment to hotel development, and what the appetite is for people to commit to major development or refurbishment projects at the moment?
I guess two different spectrum of risk in terms of refurbishment or development, but we don't do a ton of greenfield development. We do a lot of transformation capex. Right now, the situation in the Middle East has only made it the cost most uncertain, right? Supply chain disruption, yet again, and the question of inflation and whether you can get supplies on time, on budget is a key question people need to watch out for. Not just in regards to shipping, but also with regards to whether these suppliers in certain regions can get their materials to you. So that's probably the key. Though we've been saying for a while on the flip side, as investors in hotels, probably the more muted supply picture will only benefit people who own existing hotels.
Yeah, yeah. And Jack, just obviously again, not necessarily a Barclays house view, but lender attitude generally to development. Is it a really tough thing to get funding for a development project unless it's sort of light touch capex?
Yeah, it's an interesting one. So it's something that we at Barclays have done a little bit in the past, and we are looking at expanding our capability within that development financing world. It all depends on those supply chain risks, Tina has said. I mean that's the historic concern around these sorts of projects is contractor and subcontracting risk. But in our support of the sector is something we are expanding on. We're having those discussions to enhance that capability. And so I suppose what I would say is watch this space.
And Felicity, good to get your perspective. Obviously, I think you're the sort of frontline person for Hyatt, actually going out and finding new sites and agreeing development deals. As a lawyer that does a lot of these negotiations and deals, they seem to be taking forever to come along, and not because of us, just because they don't hit our desk as quickly as they should. I mean, what are the pressures for you, and what does the development pipeline look like at the moment?
So to take the last bit first, our development pipeline is actually really strong at the moment, but it's got very distinct characteristics depending on where in the region we are. So I'm covering Europe, Africa, and Middle East. In terms of Middle East, we're still seeing a lot of very ambitious new build projects come forward. Particularly in places like the Kingdom of Saudi Arabia. I know there's a lot of conversations about how many of those will or won't be realised. And so when we're looking at projects there, we are seeing a pivot away from public investment to local Saudi investors investing in Saudi. And there are obviously projects which we like to follow, but we are still seeing investments by the PIF, which is effectively the public state-backed investment fund. So that's a very specific picture. We're also starting to see conversions from unbranded hotels with local operators in those markets coming forward, which is an interesting development for us. I think if we shift, back into Europe, we're much more seeing conversion opportunities, whether that's something that comes via a sale process where, somebody's buying something, sees a value add and wants a brand as part of that, or a repositioning from, I don't know, upscale through to upper upscale and makes a change of brand to create that repositioning. And we're still seeing quite a few conversions of other buildings, offices, for example, especially in the upscale segment. There's a lot of new build projects still in Eastern Europe, especially from resorts, so creating new destinations. And I think that's going to be quite a exciting step forward for a lot of the countries kind of in Eastern Europe. And I think it will change and open people's perspectives about where they want to go on holiday. I think there's some really exciting new resort destinations being developed, and a lot of local investors working on those. Not kind of the typical capital that we would see in Western Europe. And really still a good supply of luxury projects with a lot of residential coming through. So I would say a significant part of our pipeline now are projects where there's a residential component branded residential component to the project. And really that is driving a lot of the financing motivation for that project. I think in terms of the time element of this, I think people are taking a lot longer, harder look at the terms of the deal ahead of signing term sheets, gaining the alignment. And I think one of the challenges my team faces right now is aligning risk profile. Where more and more investors are trying to offload more of their real estate risk downside into the brands. And it's really how we find the right level of alignment between us. I think that takes a lot of time and a lot of conversation. And I think once we get to the legal stage, we are seeing people being a lot more cautious and really wanting to very much understand the minutiae of what they're signing up to and keeping their long-term investment prospects open. So we're getting a lot more requests around termination on sale or what we can do on sale to help facilitate yield. So some interesting developments, but generally it's our pipeline is still strong.
Okay. Last couple of minutes. I wonder if everyone could just give a sort of summary answer as to how optimistic they're feeling about hotels in 2026 and where they see the recovery coming. Who wants to start that? Kate, why don't you start us off?
Goodness. I mean, I think this year is going to be really quite turbulent across hospitality and hotels. I am less optimistic than the other callers, the other people on the calls that I've been listening to. I think even if the ceasefire holds and everything goes back to normal in the Middle East now, we have inbuilt problems in global travel and tourism and in hospitality cost pressures. So we have a simultaneous supply and demand side problem and squeeze, particularly acute and particularly exposed in the UK, that will last probably until Q1 next year. So I am not terribly optimistic, I'm afraid. I think that the opportunities are that, well, we know while we will be first in, we will also rebound quite quickly. And again, once people have a squeeze on their ability to travel, they will want to go and experience new things and different things. But I think it is going to be an incredibly turbulent, difficult 6 to 9 months to navigate.
Okay, that's not too optimistic. Carrie,
I'm sorry, I'm not.
Carrie, are you more optimistic than Kate?
I hope so. I hope to be. I think that perhaps we'll see because of what's happening, and I mean, obviously, we heard the airline yesterday that have cancelled many of their flights. That staycation. I mean, I hope that that's going to be more where we're going to be in the next sort of 6 to 9 months. And I think there's a lot we can do there, and we have some great products out there. We have some great properties out there that actually, why not? And the weather is, hopefully we'll keep that sun shining, and that's what we get. So I have to be optimistic. That's how I see it.
Yes. Jack, are the requests for pricing going to keep flowing into Barclays over the next few months? Are you optimistic?
Yeah, I think they will. I mean, from a consumer discretionary spend perspective, it is going to be tricky. The house view and interest rates, whereas if you asked me at the start of the year, they were coming down quite significantly. They're now probably staying or even going up a little bit. So I think that is going to be tough. I think maybe I'll just put a big spin on things. England will win the World Cup, and there'll be a big revenge spend in the summer, and hospitality has a good end of the year.
Okay, that's interesting. Tina, you've kind of got two hats, I guess, because on one hand you're heavily invested already in hotels and leisure, and secondly you've got an investment pot that you want to hopefully spend on the right things. So do you feel optimistic coming in to this market at the moment?
Look, we're investors, so we have to find the right opportunities to invest in, right? And if you want to say optimistic, then I'd say probably this type of disruption and volatility is what creates opportunities for investors to pick the right winners. And I think ultimately there will be winners and losers coming out of this. It's no longer the post-COVID trend of let's just ride the wave of everyone wanting to travel. And so I think there were people I think the industry benefited from, rising tide lifts all boats, as I call it. Whereas now you really have to be nimble, smart operators, control costs, understand how to drive demand, and offer a unique experience to your consumer. And so I think there'll be moments where you can pick the right investment opportunities, and hopefully it will come at a more interesting price, given some of the volatility of the market.
Thanks. And last word goes to you, Felicity. You've got about 30 seconds before I hand back to Russell. But I mean, you've got a good development pipeline, but lots of cost pressure. So how optimistic are you feeling?
Yeah, I mean, I think I'd resonate what everybody here has just said. Adding in, we don't know what 2026 is going to look like. We're already seeing a lot of red on our monthly reporting schedules. So what I do know, though, on a very positive note, is our industry has proven to be incredibly resilient. And the people who work in the hotels, the people who are there day to day at the coalface are incredibly resilient and incredibly agile in making the best of the opportunity that's in front of them. So I believe in the people that we have making the best of what could be quite not a very untransparent time for us in terms of being able to plan.
Fantastic. Thank you to all the panelists. And Russell, if I could hand back to you for the last few minutes.
Yeah, may I reiterate thanks to all the speakers and panelists this morning. Thank you all for asking your questions. We will get back to those who are not anonymous if we haven't answered your questions during the session. And I do want to thank everybody for attending. It's good always to see so many HVS alumni. We're going to send the slides round to everybody afterwards, along with a link to a recording. This is the first webinar we've done without Karen Freeb's involvement, as Simon well knows. I'm sure Karen will be proud of the predominant involvement.
Karen is online, I believe.
She is. Yeah, I did make sure that she was before making this comment. But welcome to you, Simon, as her worthy replacement is not quite the word, but you never know. I want to congratulate Carrie on having the best real background of the occasion. There were some key themes which I took out of what's been going on. First of all, the hotel sector always recovers after major shocks. Always good to know. And learning from past experience is invaluable, and it's clear that we've all been able to do that. Travel generally is resilient, but will the airlift be there? I took away from Kate that the UK is nervous regarding costs, employment, property taxes, and so forth, and probably more hit by the reduced travel that's coming through the Middle East, transiting from Asia and the further east. We're going to be booking earlier in anticipation of price rises by airlines. That there's strong interest in the branded residential component for new development. Always good to hear that. And 5 key takeaways from each of the panelists at the very end. Kate, you're less optimistic for the UK for 2026. It's going to be incredibly difficult, but I only hope that the UK business will benefit from all the staycations that Carrie was keen that we should all be taking to avoid the reliance on airlines. Jack almost told us, and I say almost told us that interest rates are going to be going up, but then he made the biggest prediction, which is, of course, that England is going to win the World Cup and there will be revenge spending thereafter. Tina reminded us that disruption creates opportunities for investors, and also commented on the importance of being nimble when it comes to costs and so forth. And Felicity, she's uncertain, but she commented that the resilience and the agility, particularly of staff, will win through in the end. What was my final takeaway? I actually realized that I must have misheard Simon when he confessed to having eaten like a pig. But that's my conclusion for today. I want to thank everybody for participating. I hope, ladies and gentlemen, that you've enjoyed our panel today. We'll produce another one in 3 months' time, and we'll look forward to you all being with us then. Thank you again.